During that same decade, where the US dollar lost 75% of its purchasing power, the gold price went up 30-fold. Now, I'm not telling you I think that the gold price will go up 30-fold from here, but it wouldn't surprise me at all to see the gold price gain, nominal gain, mirror the loss in purchasing power of the US dollar. And so for me, the gold market is very, very, very much intact.
You're watching CapitalCosm. My name is Danny. It is August 12th, 2025. And my guest today is none other than Rick Rule. Rick, thank you so much for coming back on the show, my friend.
Pleasure for being with you. Thank you for having me back.
Yeah, I know you just told me before we hit record that you were, knee deep in quarterly statements and analyzing various companies, but we're going to do a little it's going to be a little pit stop for you from that. But let's go ahead and dive right in to the swing of things. And let's get your take on what investors should be most privy to right now. What should they have their sensors pointed at? What should be on their radar screens as we barrel through towards the end of the summer here?
I think resource investors need to begin to become concerned about their own hubris. In a market like we've had for the last 18 months, where sometimes even your mistakes are making you money, it's easy to confuse a bull market with brains. A narrative that you have believed in or come to believe in during a bear market, while that narrative is correct, your psyche is tested. Because while that narrative is true, it can take a long time to play out. As it starts to play out and the price levels rise, the fact that the price levels rise validates that narrative for you, and it causes you to become increasingly confident. Remember that as the price levels rise, the narrative actually becomes less valuable. It becomes more certain, but the reward for adhering to that narrative becomes less valuable because the price that you're paying for the assets increases. So I would suggest to you, Danny, that what resource investors need to begin to do is question whether or not the actions that they're taking now are a consequence of their having identified value, or whether they are becoming overly confident and hubris ridden. I notice, as an example, that the junior resource industry, which described itself as bereft of funds 18 months ago, is rushing to market with all kinds of fresh paper. And these financings are very frequently oversubscribed. This is not evidence of a bear market. This is evidence of a confident and, on occasion, overpriced market. I'm not suggesting, by the way, that the bull market is over. It isn't. But bull markets don't exist as stairways to heaven. You don't always see higher highs. You see highs and lows. It's impossible. Pardon me. It's completely possible that you could see, never mind in terms of individual issues, but in terms of the overall market, a pullback which would stress some of the faithful. So I would encourage people who are participating in this market today to attempt to use the same type of discipline that they used 2 years ago or 2.5 years ago, irrespective of the momentum that they find in the market. And I would ask them to consider every decision that they make juxtaposing the confidence that they feel today with the fear that they felt 2 years ago.
Now, with the exception of, let's say, the precious metals, i.e. gold, silver, and platinum, making either all-time highs, or in the case of platinum, decade-long highs, and in the case of silver, decade-long highs as well. What other commodities and natural resources have made these new highs? Because if you look at, let's say, like any commodity index, we're still well below our 2022 highs.
But the stocks have bids. Some of them deserve them, but the stocks have bids. If you Look, as an example, at the success being enjoyed, admittedly, by franchise stocks. Fireweed would be an example. NGEX would be an example, both Lundin companies. Uh, those stocks have made 4 or 5-fold gains. And I'm not suggesting that they don't deserve it. I'm just suggesting that those gains aren't reflective of the type of market that many people think it is. I would suggest that the uranium juniors, too, while the structure of the uranium market could take it higher, the pervasive hate that existed in the market for uranium juniors 8 months from now, well, pardon me, 8 months ago, is gone. We talked about this the last time I was on your show. There was a package of uranium juniors that I bought 8 months ago as simply as a consequence of the fact that they were really, truly, thoroughly hated. That portion of stock, which I added to my core portfolio as a consequence of feeling that they were hated, has now been sold. I wouldn't describe them as young, as loved, pardon me, but I would certainly suggest to you that the undervaluation that was due to hate is gone from the juniors. The problem, if it's a problem, the condition that I describe is, of course, the most uh, developed, the most advanced in the gold companies. And again, I'm not suggesting that this bull run is over. The extraordinary earnings release that Newmont came with um, tells me that the gold industry as a whole is very high. I'm only suggesting to you, Danny, that people who regarded themselves as contrarian, particularly in the precious metals market, uh, need to revisit their premise.
And from a time horizon perspective, I know you've said that the long-term bull market is still intact. However, from a time horizon, if you were to slap one on it, I mean, what's the likelihood that a pullback arises within the next, months or weeks ahead, or something to that effect?
Not smart enough to tell you. Your audience just needs to prepare themselves for the inevitable. And they need to understand the value of their holdings relative to the price well enough that if they experience a 20% or 25% price decline, that they have the guts to hang on. And if there are positions that they hold that would cause them trauma in that circumstance, they might consider taking some off the table. I think I've noted, Danny, in interviews with you in the past, that when I look at my really big speculative wins, virtually all of them exposed me to 50% share price declines during some period of the time I owned them. And it's important if somebody is gunning for 10 baggers or 15 baggers to understand something about the current value of the company, which is to say the liquidation value, to understand something about the size of the prize, the amount of time it's going to take to the size of the prize, and to steel one's self for the volatility and the real risk that you certainly will experience on the way to recognizing that. It's interesting. Yeah, I don't know if you ever had to suffer through my tuna fish parable, but it's interesting when somebody goes to the store and buys a consumer good. They like them on sale. If the price of something that they bought went down, they tend to hoard it. In stocks, it's very different. If you buy something and the price goes down, you tend to sell what you've already bought. I would suggest that people often buy consumer goods more intelligently than they buy financial goods.
Right. And it's mainly because of the psychological aspect of the herd. When the herd sees the herd moving in a certain direction in unison, I guess there's a primal instinct behind it. Now, Rick, I know you've got a part 3 to your ongoing series on gold investing, Rick Roll's Gold Investment Bootcamp Part 3. But before we dive into that, let's go ahead and talk about the overall gold market. I know we talked about the broader natural resource market, but let's go ahead and get your view in terms of where you see the gold market heading as of right now. we shot up. We shot up to 34 and some change over the course of the last month or so. Came back down, shot back up during the tariff announcement, came back down again after President Trump made his clarification. So what's going on in the gold market? We've been consolidating since April. But then if you look at last year, last April of 2024 up until August of 2024, we saw that same type of consolidation as well. Does history repeat in this case, or does it rhyme, or none of the above?
For me, it's all noise. I own physical gold because I'm concerned about the deterioration of the purchasing power of the US dollar. And I'm concerned about what I would describe as negative real interest rates, which we can get to. And those two trends are, from my point of view, unbroken. So whether gold is at 34 or 32 or 36 is of absolutely no consequence to me. The fact that it's of no consequence to me, though, shouldn't lead to other people's investment or trading decisions. It might be, as an example, that they see themselves as traders. I don't. My own gold, I see as my attempt to maintain my purchasing power over time. Uh, Maybe that's why I'm so sanguine about it. When people ask me about the gold price direction, uh, I often like to describe what would make me sell my gold. I would sell my gold when I saw a political accommodation in the US that would allow us to deal with $100 trillion in the net present value of entitlements. Many people don't realize this, but the off-balance sheet liabilities of the US government, the promise that our government has made to its citizens with regards to Medicare, Medicaid, Social Security, military pensions, government pensions, that number, according to the Congressional Budget Office, exceeds $100 trillion. We can't pay it. And politically, we can't not pay it. So, in order for me to sell my gold, I would need to see some political accommodation uh, around that. Otherwise, what I think happens is that you honor the nominal valuation obligation by devaluing the purchasing power of the currency, like we did in the decade 70s. The second thing I'd need to see is some method for dealing with the on-balance sheet liabilities of the US government. That number now exceeds $37 trillion and grows by $2 trillion a year. At the very least, I'd need to see a balanced budget, which I don't suspect I'll see in my lifetime.
Fair enough. Oh, go ahead.
The third thing I'd need to see is positive real interest rates. And this is a bit more nuanced. When most people think about inflation, we have been conditioned to think of inflation in the context of a number called the CPI. And the CPI, people need to understand, is a constructed index. It isn't a measure of anything. But it has managed to infiltrate into the public psyche to the extent that when the citizenry thinks of inflation, they think that the deterioration of the purchasing power of the US dollar is proceeding along at about 2.5% per annum. I would ask people to construct their own informal index, going back to, say, the year 2000, or to make it easy, 2025. And if you do that, what you'll find is the deterioration of the purchasing power of your savings in terms of the basket of goods and services that you consume is happening at a pace more like 7.5 or 8% than 2.5%. If you juxtapose that number to the yield you get on risk-free savings assets, say the US 10-year Treasury, the problem becomes obvious. If you're getting paid 4.2% to save over 10 years in an asset class where the value is declining by 7.5% a year, you're losing 3% a year compounded for 10 years. If you give the US government $100,000, they give you back something like $60,000 in purchasing power. The consequence of that is that real savers are beginning to save in gold as opposed to saving in US 10-year treasuries. So when I think about gold, I think about what would make me sell it and do something else. It would be useful to see a real yield on savings. Now, I think that's a long ways away. If the currency is declining by 8% a year to make the math easy, and if investors would expect a 200 basis points or 2% real rate of return, that would put the US Treasury rate at 10%. That would likely put the first mortgage rate at 12%. That would be an interesting set of circumstances. And there's prologue for this, Danny. If you look back to the decade of the 70s, the US dollar, according to the then Office of Management and Budget, lost 75% of its purchasing power over 10 years. Many people don't realize this. Perhaps like yourself, they weren't alive then. But if you think about the consequences of the US dollar losing 75% of its purchasing power on the lifestyle of savers or people who save in long-term bonds and stuff like that, it's pretty profound. During that same decade, where the US dollar lost 75% of its purchasing power, the gold price went up 30-fold. Now, I'm not telling you I think that the gold price will go up 30-fold from here. But it wouldn't surprise me at all to see the gold price gain, nominal gain, mirror the loss in purchasing power of the US dollar. And so for me, the gold market is very, very, very much intact.
Hey guys, quick pause from the podcast, but this is something I feel is really important to let you in on. Back in 2020, before I even started this channel, I was looking for an edge, a way to find the big opportunities most investors never even hear about. That's when I found Capitalist Exploits Insider. From day one, it felt like I suddenly had my own team of world-class market pros working for me, digging up trades all over the world, doing the deep research, and handing me ideas that had massive asymmetric upside. Stuff that I would never even think about. Since then, my gains with them have blown past the S&P and the NASDAQ, and it's honestly the single best newsletter I've ever subscribed to. And that's not me blowing smoke. That's for real. I've interviewed their publisher, Chris McIntosh, more times than I can count. In fact, my latest conversation with him is linked in the description box down below if you want to check that out, as well as a pinned comment. And every time, I'm reminded why I've stayed a member for years. Right now, they're offering a special $1,000 discount on the Insider subscription, but it's only for CapitalCosm viewers, so you're only going to get it by clicking the link down below in the description box or the pinned comment. You're not going to find this anywhere else. Click the link, lock it in, and start getting the same game-changing research I've been using since 2020.
Will it be stairways to heaven? No. I remember myself in 1975 in the middle of that epic bull market where the gold price went from $35 to $850. In 1975, they raised the interest rate, trying to tame inflation. And the gold price fell by half. It fell from $200 to $100. And the gold stocks fell more. People who got shaken out because Congress lost their nerve at the end of 1975. The people who got shaken out of that epic market missed out on the second half of that bull market that saw the gold price go from $100 to $850.
That basically implies that hodling or holding is the most likely path to success, to succeed. I mean, you've mentioned this Fidelity study before on the channel as well, and the TLDR, the summary version of it for those who aren't aware, and it is that there's a study done that looked at a variety of different investing methodologies, and the one that came out to be the most successful with the highest returns was the investment strategy where you just die and you let your portfolio run ad infinitum, without tampering with it. And so Very.
I'm going to attempt to implement that strategy without the most drastic of all protocols. I'm going to try and implement it without the necessity to die.
Yeah.
And there likely will come a time in my lifetime where other asset classes become cheap relative to gold. I know myself in 2010, before the top in 2011, there were asset classes that seemed to be more attractive than my gold, and I sold a reasonable bit to transfer out to those asset classes. I'm not going to claim that I top ticked it because I didn't. But there will likely be a time, even in my life, I'm 72 now, where gold has served its purpose, and there will be other asset classes that will deserve the liquidity that I have in gold more than my gold does. But I don't suspect we're going to be there for a while.
Yeah. Yeah. Well, Rick, I think this is a perfect segue now to get into the part 3 of your gold investment bootcamp series. We've had 2 previous iterations. Talk to us about this one. What makes this one different? What sets this apart from the previous 2?
We, for those of your listeners who don't know what the boot camps are, every 90 days, we do a very deep dive into one aspect or another of natural resource investing. We've done uranium, we've done silver, we've done all those kind of things. And we asked our audience what subject they'd like us to dive deepest into next. And the answer came back very resoundingly gold, like 75% of the responses were gold. And we wrestled ourselves with how to do a gold boot camp in 8 hours, which is to say, how to cover the topic of gold in 8 hours. And we decided it couldn't be done, or at least we couldn't do it. And so we divided the gold boot camp into 3 series. The first part was the history of gold, gold as money, gold as a commodity, how to own, buy, sell, store physical gold. A bit about gold futures and options, but we talked about gold more as a metal, more as a commodity, more as money. The second boot camp, we talked about the investment quality gold companies. What makes a great gold company? That is, we moved beyond gold, physical gold, as a savings product or as an insurance product, and into the best of the best gold producers as investment products. We did that partially because gold bull markets in my lifetime have followed a very predictable pattern. The gold moves first, and as the momentum in gold and the increase in the gold price outpaces the increase in the cost of producing gold, the first of the subsequent assets to move, related assets, are the senior gold producers, which you've seen in the last 18 months. The share price increases that we've enjoyed in what I call the golden triumvirate, Franco-Nevada, Wheaton Precious, and
Right.
Agnico Eagle, have been stunning. And we wanted to cover that because for many people, merely capturing the beta in gold equities, which is to say the extent to which the gold equities outperform the broad equities, is a good low effort and low risk way to play the game. And so we try to teach people how to do that. The third thing will be the rest of the value chain, but with a real emphasis on sub-billion and sometimes sub-$100 million companies. So if the first part was gold itself, and the second part was investing in gold equities, this will be about gold speculation. It'll be about the mergers and acquisition game. It will be about the fact that index investing is increasingly important in the gold sector, and hence scale and volume by itself lower cost of capitals, lower the cost of capital. By the way, this is a very deep 8 hour deep dive. This is not the kind of course for a tourist. This has to be for somebody who wants to learn and who is prepared to spend 8 hours in the session and probably play the tape, the recordings, which will be available to you as a subscriber for a year. More than once. So when I say it's an 8-hour obligation, that's wrong. It's more like a 16 or 24-hour obligation to get your money's worth.
Yeah, and it's not just sizzle, like you said. It's a big fat steak coming along with it. So plenty of stuff to whet your appetite with here, Rick. I can't encourage my audience enough to check out the Rickroll Bootcamp series. All of these boot camps are always just go above and beyond in getting you guys acclimated with some of the best methodologies and ways of looking at natural resource investing that you're just not going to find anywhere else, especially at the caliber of talent and that Rick provides. Go ahead, Rick.
I should add that all of our educational products, be it our boot camps, be it the conference in Boca Raton, all of these unusually come with full money back guarantees. If you come to the boot camp, honestly spend 8 hours at the boot camp and come away thinking that I didn't give you your money's worth, email me. I'll give you your money back. Now, we've been making this guarantee, I'm told, for 30 years, and we've had to refund less than 1/10 of 1% of the tuitions that we've charged. But this is probably the only riskless transaction in the mining business. If you suffer through 8 hours of this and you come back thinking that for some reason I didn't give you your money's worth, no worries. I'll give you your money back.
Let's go ahead and segue over to some macro topics. It appears that we are anticipating rate cuts. They're being priced in heavily now. You're probably not going to get above 25 basis points here. But given the fact that we cut rates around this time last year and saw really no correlation with the 10-year yield, in fact, the 10-year yield actually diverged a bit from the Fed funds rate when we cut. What's at stake here? I mean, it seems like if the 10-year doesn't move in tandem with whatever the Fed cuts, I mean, could this not spark some low confidence vote in the Treasury market or the debt market or something like that?
It's important to note what you just said, which is to say that the near term market is already highly liquid. And the Fed has already been jawboning, as have the political class, interest rates lower. Despite that, the long bond has been increasing, which suggests that the political forces are beginning to lose control of the market
Mm-hmm.
to the market. That means that if they want lower interest rates, they're going to have to use brute force. And that brute force will signal to savers around the world that the US government has decided not to defend the integrity of the purchasing power of the US dollar. um, that'll have a couple of positive, I shouldn't say positive, a couple of impacts. It may very well be good for equities markets. It would certainly be good in the near term for the long term debt market. I don't speculate in bonds. I speculate other places. It likely would be rocket fuel for gold, perhaps rocket fuel for silver, much like 1975 was. I think it'd be a tragedy for the U.S., and I think it's going to happen, unfortunately. In my ideal world, uh, the government would not manipulate interest rates. Artificially low interest rates are really a way to penalize savers on behalf of spenders and investors. They benefit me. I have access to credit and I have the knowledge as to how to use credit. But for all the middle class savers who've done the right thing all their lives, save 10% of their income pre tax to sustain themselves in their dotage, this artificially low interest rate is really theft. And in terms of the pricing signals that you'll see in the rest of the economy, I don't think it will be particularly pretty. I do think it'll happen.
And what does it spell for gold?
If it becomes clear to people around the world that the US government has no interest in maintaining the purchasing power of the US dollar, uh, I think it would be very, very good for gold. It's interesting that devaluation of the national currency has been viewed by the political class and the corporate class as in their interest for a very long time. Hence, the Europeans cut their rates relative to the US. The US tries to cut their rates relative to Japan. Japan tries to cut their rates relative to China. One of the interesting parts about gold, if you think of it both as a store of value and a medium of exchange, is it's probably the only money in the world that doesn't have a domestic political constituency for devaluation. I Well, I suggested at the top of our show, Danny, that I expect in absolute terms the purchasing power of the US dollar to decline by 75%. I think the US dollar likely will perform in line with a basket of other currencies. In other words, I'm not suggesting because the US dollar declined that people, as an example, swap out US dollars for Australian or Canadian dollars or something like that. I think you're going to have to be nimble saving in currencies. I think in an absolute sense, the US dollar loses 75% of its purchasing power. And I'm afraid that coincidentally with that, the forces that be, which is to say the voters and their representatives, will exacerbate the problem by maintaining artificially low interest rates. You will recall, or perhaps you won't, but your older viewers will, that the ultimate consequence of 10 years of devaluation of the US dollar and the psychology of inflation that occurred in the decade of the 70s, that the interest rates had to climb ultimately to rates in excess of 18%. And the process by which, uh, the reckoning by which we restored the integrity of the US economy was a truly ruinous recession in the 81, 82, 83 period, where we dealt with repairing and restoring the US dollar through high interest rates.
Yeah. Well, on one more note here, Rick, we did get these new CPI numbers today, and it came in at 2.7% for the month of July. Now it's a little lower than expected, which President Trump using as fuel to push for his rate cuts. But let's go ahead and take a look at these individualized items and how they've grown. And actually, core goods, as they referenced here, whereas core good prices are at their highest annual inflation rate in about 2 years. So, food at home is up 2.2%. Eggs are up 16.4%. Roasted coffee 14.8. Food away from home is up 3.9. Energy is up 1.6. Then everything else, less food and energy, is 3.1. Do these numbers surprise you at all?
What surprises me is what people allow not to be included in the index.
Hmm.
Do you see a heading there for tax?
Nope.
So what's the cost of living index that doesn't include tax? Now, Danny, if I didn't have to pay the tax, I wouldn't bitch quite so much about the index. Uh, but I need to say uh, the exclusion of that. I would ask, again, I would ask your listeners to think a little bit. Don't waste a whole bunch of time at it, but think about the progression in their cost of living in the period 2020 to 2025. Mortgage interest rates have doubled. Rents are a political issue. Groceries, as you suggest, are a political issue. Energy costs have doubled. And yet the CPI tells us that the deterioration of the US dollar for 5 years has been 2.6% a year compounded. Mike Maloney correctly, I think, describes the CPI as the CP lie. It's interesting that it's such an important part of the fabric of the conversation around the US dollar. And really, it's a fabricated fraud. The inflator in entitlements payments, particularly Social Security, is of course tied to the CPI. And one part of the political falsehood that we exist in today is that your benefits are tied to a number that is unrealistically low relative to the deterioration of the dollar. But of course, taxes aren't similarly constrained. So I would caution you at the outset from relying on the CPI for much of anything. Remember too that it's hedonistically adjusted. So, as an example, that the price that you pay for health insurance is adjusted to reflect the quality of the health care that you allegedly enjoy in 2025 relative to the health care that you enjoyed in 2000. Similarly, what you paid for a computer is adjusted by the output of your computer today relative to other times, which is to say, really, that the CPI is a construct. It's not an index. I began informally uh, keeping a second ledger for myself beginning in the year 2000, where in addition to keeping track of my income and my expenses and my portfolio in my normal medium of exchange, which is to say the dollar, I began to keep a separate ledger in gold. And gold has increased in nominal terms, which is to say against the US dollar by about 9% compounded for 25 years. If you measure your cost of living in gold, and I still haven't learned to think that way, I need to force myself to do it. But if you measure your cost of living in gold, you'll be astonished how cheap your groceries are, how cheap your gasoline is, how cheap your house is relative to the year 2000. And I would encourage people to think informally about their life in a constant rather than a nominal sense. I'm interested today in the minimum wage discussion, where people talk about how little the minimum wage has grown relative to their expenses. If you take yourself back to 1970, uh, measured in silver, the minimum wage was something like an ounce and a half of silver in 1970. Today, that would be and my numbers may be off a bit, but that would suggest a 37 or $38 minimum wage. It's important that you understand that your own measurement of your income, your assets, your expenses uh, is it, it's being measured in a floating abstraction. And if you're making plans for the next 10 years, it's important that you normalize your medium of measurement away from the floating abstraction.
Yeah, a floating target, so to speak, if you were to measure it
Correct.
in fiat, but to hold everything constant in terms of gold, or in the examples that you provided, silver as well, provides a better outlook, because people know the price of everything, but the value of nothing. I'm sure you've heard that saying before. So, all right, Rick. Well, it's been a pleasure having you on. Anything else you'd like to bring up here before we wrap up?
Well, two things since you give me the opportunity. The first is if you like the way I think about natural resources, you can personalize it. If you go to my website, ruleinvestmentmedia.com, and list your natural resource stocks, I personally will rank them and review them for free. Please no pot stocks, please no crypto. Leave an old guy to do what he does well. The second thing is our bank, Battle Bank, is soon to open. If for any reason whatsoever you're less than happy with your current bank, check out battlebank.com. If you're interested in interest, as an example, there's over $1 trillion on deposit with U.S. banks that pays no interest. We might pay you interest on things like your checking account. If you'd like to save in currencies outside the US dollar, including gold or silver, we'll do that for you at Battle Bank. If you own a lot of gold and silver and you'd like to access credit using your gold and silver for collateral, even if you don't use the credit, just access the credit, have a credit line, think about Battle Bank. So battlebank.com. If for any reason at all you're unhappy about or fearful about your current bank.
All right. We will have the link to all of your websites down below. So check them out, guys. And if you guys got value out of this podcast, drop us a like and comment, go, Rick, go. in the comment section. If you disagreed with anything, that's fine too. But let me know why you disagreed. Let me know what you disagreed on. Because in fact, I do read all the comments. So let me know your thoughts, good and bad. And subscribe to the channel so you don't miss another episode. Liking, subscribing, commenting, doing all that stuff helps push this video and this channel up in the algorithm. So a little bit certainly goes a long way. And then finally, again, I want to encourage you guys one last time to check out the Rickroll Gold Bootcamp Part 3. If you enjoyed the first two, I'm sure you won't be disappointed with this one. If you've yet to watch the first two, Rick, I believe they're still available for viewing, aren't they?
Absolutely. All of our boot camps historically are available for viewing. And the same deal applies. If you buy any of the library and you don't think you got your money's worth, no worries. I'll give you your money back.
Yep. So check them all out down below. We have a special link for the boot camp down below. So check it out, guys. And thank you so much for your time. Rick, thank you for your time. And I will catch you all later. Bye.
Thank you, sir.